The world's largest gold and silver market is completely offline, and it's going to stay that way until February 24th. Mainland China markets are scheduled to be closed February 16th through 23rd, reopening Tuesday, February 24th. That's 8 full trading days without the country that dominates global precious metals demand. China is the #1 gold mining nation, the #1 importer and consumer, and most likely the #1 central bank gold buyer too. Right now, gold is holding below the $5,050 level, despite ongoing expectations of Fed rate cuts, while silver is slipping towards $75, and we're navigating this liquidity vacuum just 9 days before the March silver delivery pressure reaches its peak. This is the single most important week for precious metals in 2026, and I'm going to break down exactly what's happening, what the data is telling us, and how you need to position yourself. If you're serious about protecting your wealth during periods of extreme volatility, hit that subscribe button right now. This is the kind of real-time analysis that can make the difference between panic and preparation. Now let's get into the numbers. Liquidity is lower than normal during Asian trading hours because Chinese markets are closed this week for the Lunar New Year holiday. But let me be clear about why this matters more than any previous holiday closure. A wave of speculative buying propelled a multi-year rally to its breaking point, sending gold soaring to a record above $5,595 an ounce in late January. Bullion has since recovered about half of its losses in erratic trading after a sudden 2-day meltdown at the beginning of the month that pulled it back nearly to $40,400. We just experienced the most violent precious metals volatility since 2008 for gold and 1987 for silver. And now we're entering the thinnest liquidity window of the entire year. Regionally, the practical market impact is a short window where positioning gets lighter, volatility can be jumpy on small flows, and reopen gaps become a feature, especially if FX or commodities move sharply while China is closed. Expect lighter risk, wider spreads, and higher headline sensitivity into the break. Let me give you the exact price picture. Today's trading range for gold futures is between $4,885 and $5,070. The 52-week price range spans from $2,866 to $5,726. That's a range of nearly $2,800, and we've seen most of that move in just the past 12 months. On February 11th, gold was valued at $5,072 per ounce, a 20-footer uptick from the day before and more than a 2,168er gain over the past year. Silver's story is even more dramatic. Silver rose to $84.72 per ounce on February 11th, up 4.88% from the previous day. Over the past month, silver's price has fallen 0.52%, but it's still 162.45% higher than a year ago. Let that sink in. Silver has more than doubled in 12 months, yet it remains extremely volatile. The white metal remains roughly 30% below its late January peak, following a sell-off that briefly erased nearly half its value. Here's the critical context for today. February 18th brings the release of FOMC minutes. February 19th brings U.S. initial jobless claims data. February 20th brings U.S. GDP data for Q4, as well as manufacturing and services PMI data for February. Every single one of these releases is happening while China's markets are completely dark. Gold prices may remain highly volatile this week amid the release of FOMC minutes, U.S. jobless claims data, other macroeconomic reports, and commentary from Federal Reserve officials. The FOMC minutes releasing today could be a major catalyst. The main effect from FOMC meeting minutes comes from expectations regarding changes to interest rates. If the minutes suggest that the Fed is favoring rate hikes, then the dollar tends to strengthen. However, if it suggested that the Fed is favoring rate cuts, then the dollar tends to weaken. In a thin market, these moves get amplified dramatically. A sustained move above $5,050 may require dovish signals from the FOMC minutes. Now let me explain why China's absence from the market creates such extraordinary risk. This dominance in gold's physical flows has been true for well over a decade, but it's the explosion of speculation and derivatives betting which has really seen China's trading activity start to set the direction of bullion prices worldwide. China and India's combined control of more than 50% of global bar and coin consumption creates unprecedented geographic demand concentration in precious metals markets. With global bar and coin demand reaching 374 tons in 2025, a 12-year high valued at a record-breaking $154 billion, Asian markets now drive global supply allocation and pricing dynamics. The pre-holiday demand data is staggering. During the 2026 Lunar New Year period, Chinese retailers reported gold jewelry selling at approximately $221 per gram, representing a dramatic 71.7% price increase from the average during the corresponding 2025 period. The 2026 season demonstrated that cultural demand can override traditional price sensitivity, as consumption remained strong despite 71.7% price increases year over year. In the run-up to Lunar New Year, Chinese consumers were busy choosing gold jewelry, a traditional gift with deep cultural connotations, as strong market sentiment overshadowed sharp fluctuations in gold prices. Chinese New Year is now the largest single gold buying festival worldwide, overtaking Diwali in India. And with prices surging almost threefold for Chinese consumers over the past 5 years, households wanting to get the most gold for their money are increasingly switching from high-margin jewelry to buying small bars and coins. But here's where it gets interesting. The volatility before the holiday actually triggered some unusual behavior. In China, known for its strong affinity for gold, the period before the Lunar New Year typically marks peak gold demand. However, recent market volatility has prompted even individual investors to sell, an unusual development. The World Gold Council just published critical data on Chinese demand. The local gold price kicked 2026 off with its strongest January on record. And while it pulled back sharply in late January and early February, gold bounced back since. In January, investment demand benefited from the powerful gold price rally. Wholesale demand was robust. Withdrawals from the Shanghai Gold Exchange totaled 126 tons in January, a mild 1-ton year-over-year increase and 11 tons higher month-over-month, thanks to strong bullion sales and jeweler restocking activity ahead of the Spring Festival. Chinese gold ETFs added 44 billion yuan, roughly $6.2 billion and 38 tons in the month, the strongest start to a year on record, with assets under management and holdings reaching all-time highs. In the face of January's record-shattering gold price, the PBoC announced its 15th consecutive monthly gold reserve increase, adding 1.2 tons to its official holdings. This brings the official gold holdings to 2,308 tons, 9.6% of total reserve assets. Now let's talk about the COMEX silver situation, because this structural tension is unfolding in parallel with the Chinese holiday. As of early February, the March silver contract showed roughly 400+ million ounces of open interest. Meanwhile, registered silver inventories hovered near 100 million ounces. That's the setup behind the COMEX default narrative. As of February 5, 2026, March open interest stood at 429 million ounces. COMEX registered silver inventory was 103.5 million ounces and falling. February delivery rate hit 98% with 18.72 million ounces, delivered from 19.11 million ounces open interest. Inventory drainage rate was running at 785,000 ounces per day. COMEX registered silver has fallen from 167.7 million ounces in October 2025 to 103.5 million ounces in February 2026, a 38% decline in just over 3 months. The drainage rate has accelerated to 785,000 ounces per day. If this continues through February 27th, March 1st notice day, only 85 million ounces may be available. But I need to give you the counter-argument because balanced analysis matters. There is currently no strong evidence that the COMEX is at risk of defaulting in March. While open interest in silver contracts exceeds registered inventory, most futures contracts are settled or rolled over before delivery. Historically, major months see lower delivery percentages relative to open interest, even though participation is higher overall. In other words, you cannot project February's behavior onto March. When delivery occurs on the COMEX, physical silver does not typically move. A delivery is a transfer of a warehouse receipt, essentially a warrant of ownership. The silver stays in the vault unless the new owner decides to withdraw it. What's the expert consensus on where we go from here? Hebe Chen, an analyst at Melbourne's Vantage Markets, said that recent price movements reflect orderly consolidation and light profit-taking following the push above $5,000 that followed Friday's U.S. inflation data. Experts believe gold prices still have significant room to rise over the medium to long term. Peter Grant, vice president and senior metals strategist at precious metals brokerage Zaner Metals, told Reuters that the recent price decline is a technical correction within a long-term upward trend, noting that fundamental factors supporting gold prices remain solid. Experts expect gold to trade in the 4,114 to 5,119 range by the end of the month. That's an $800 potential range, which tells you everything about the uncertainty in this market right now. The macro backdrop remains supportive for precious metals. Gold climbed above $5,070 per ounce on Tuesday, near a 2-week high as the latest U.S. data reinforced expectations for a more accommodative Federal Reserve stance. Softer activity indicators have already moved rate pricing, with December retail sales stalling unexpectedly and the GDP control group slipping 0.1%. Markets have since priced in a higher probability of 3 Fed rate cuts this year, up from 2 just a week ago. Markets currently price in roughly 60 basis points of Federal Reserve easing by year-end. Safe haven demand has also been fueled by a rotation away from dollar-denominated assets amid growing concerns over policy uncertainties in Washington. Global silver supply has been in persistent deficit for 5 consecutive years, with the 2026 shortfall projected to approach 200 million ounces. Industrial demand driven by solar panels, electric vehicles, 5G infrastructure, AI hardware, and medical applications is growing far faster than mine output. Here's my assessment of this week's likely scenarios. The base case is choppy, range-bound trading with elevated volatility on any news catalyst. On February 17th, gold is expected to continue consolidating within the 4,137s to 5,107 range. For silver, I'm watching the $75 to $80 corridor as the likely trading range through the blackout period. The bullish scenario requires dovish FOMC minutes today, weak jobless claims Thursday, and soft GDP data Friday. If all three align, gold could push toward $5,150 and silver could reclaim $82 to $85. The bearish scenario involves hawkish minutes, strong economic data, and a dollar rally that pressures metals lower. In thin liquidity, gold could test $4,900 support, and silver could slide toward $72. Watch offshore China proxies like CNH and H shares for price discovery, then potential catch-up moves when A shares reopen February 24th. For positioning, here's what I suggest. If you hold physical metal, do nothing. This volatility is exactly why you bought it. Let the noise pass and focus on February 27th, March First Notice Day, as the next meaningful event. If you trade futures, reduce position size by at least 30 to 50% through the blackout. Widen your stop losses to avoid getting chopped out on gap moves. Use options if you want exposure, because at least your risk is defined. The key levels to watch are clear. For gold, $4,150 is near-term support, and $5,100 has acted as resistance where profit-taking emerges. Gold remains capped below the $5,050 level, despite ongoing expectations of Fed rate cuts and lingering geopolitical uncertainty. Price action reflects cautious positioning ahead of the FOMC minutes. The bigger picture remains structurally bullish. Gold purchases by central banks totaled 863 tons in 2025 and are expected to ease slightly to 850 tons in 2026. The World Gold Council expects investment interest in gold to remain strong, along with steady demand for physical gold, driven by ongoing geopolitical tensions, expectations of interest rate cuts, and pressure on the US dollar. Lunar New Year does not guarantee higher prices every year, nor does it override fundamentals such as interest rates, currency strength, or central bank policy. However, historical data shows that physical precious metals demand consistently rises ahead of the holiday, particularly in Asia. I'm genuinely curious what you think about this setup. Are you positioned defensively heading into the liquidity blackout, or do you see this week as a buying opportunity? Are you watching the FOMC minutes closely today, or focusing on the bigger picture? Drop your thoughts in the comments because your perspective helps shape future analysis. Here's the bottom line. February 18th through February 24th represents the most dangerous trading week of 2026 for precious metals. We have FOMC minutes today, jobless claims Thursday, GDP data Friday, all hitting markets while China is completely offline. China is running an extended 9-day Spring Festival holiday with officials expecting a record travel surge, but liquidity will be thin. The structural story remains intact. Central banks continue accumulating gold at historic rates. Silver's industrial deficit is deepening. Physical demand in Asia shows no signs of weakening, despite prices that have nearly doubled in a year. But short-term liquidity is king, and we're about to have 8 days without the king of liquidity. Survive the week. Watch offshore proxies for price discovery. Keep your eye on February 24th when China reopens and February 27th when March delivery pressure peaks. Don't try to be a hero in thin markets. Reduce risk, widen stops, trade smaller, and let the volatility pass. If this analysis helped you understand what's really happening in precious metals right now, hit subscribe. I'll be tracking every significant development as we navigate this critical period. Remember, this is educational content to help you make informed decisions, not personal financial advice. Your situation is unique, and you should consult with qualified professionals before making any investment decisions. Stay sharp out there, and I'll see you in the next update.